Welcome to this custom-tailored deep dive. Usually when we talk about a physical space, like a warehouse, there's this expectation of simple utility for the listener.
Right. Just a box to put other boxes in.
Yeah, exactly. You put things in, you take things out. It's tangible, just, shelves, forklifts, concrete floors.
I mean, it's comforting to view supply chains like that. Just physical objects sitting in rooms waiting to be moved.
But if you step into the world of inventory management and corporate finance, that simple warehouse instantly becomes something entirely different.
Well, completely. It transforms.
Right. We are looking at a landscape that is actually a massive, volatile financial engine. It's just masquerading as a building full of cardboard.
Because every single physical box sitting on a shelf represents a financial ripple effect, one that impacts an entire company's viability.
And honestly, the stability of the global supply chain. Which brings us to our mission today. For you listening, if you love to learn and want to get past the jargon, today is for you.
We are unpacking Module 6, Section B from our source materials today.
Yep. We are going to connect the dots between a pallet of goods sitting in the dark and the millions of dollars moving around on a CEO's balance sheet.
Because inventory costs and basic accounting might sound like dry textbook material.
It really does.
But it is actually the secret language of business survival. The physical items are just the surface layer.
Right. Beneath that is a complex web of capital allocation, risk management, and, strategic accounting choices that most people never see.
Which is why we need to unpack this. Every decision made on the warehouse floor hits the financial statements.
Okay, let's unpack this. Before we can even begin to account for inventory in a corporate spreadsheet, we have to establish what it actually costs a company just to, hold it and order it.
Right, because the most common pitfall in business is assuming the cost of inventory is simply the price tag paid to the supplier.
Exactly. I buy a mug for $1, the inventory cost is $1, but that's not true, is it?
Not at all. The reality involves two massive opposing forces. You have carrying costs and you have ordering costs.
So let's start with the carrying costs. The mathematical formula from the source material is pretty straightforward. Carrying cost equals the carrying cost rate multiplied by the average inventory level in dollars.
Right. But the implications of that calculation are just staggering when you look at real numbers.
Let's use the specific example they gave us to make it real for you. Imagine a company with an average annual inventory sitting at $3 million.
Okay, $3 million.
And their specific carrying cost rate is calculated at 24%.
And that 24%, it's not just a random guess, it is a meticulously constructed metric.
So break that down for me. Where does the 24% come from?
In this scenario, it consists of a 9% capital cost, an 8% storage cost, and a surprising 7% risk cost.
Okay, the capital cost makes intuitive sense. That 9% is basically the opportunity cost, right?
Exactly. It's the return the company could have generated if they had invested that $3 million into, say, research and development.
Or paying down debt.
Yeah, instead of tying it up in physical goods. And the 8% for storage is also very tangible.
Right, that's the lease on the warehouse building, paying for the electricity, the security guards.
Yeah, the physical reality of housing this stuff.
Right.
But then there's that 7% risk cost.
Yeah, I want to zero in on that. Wait, what exactly is the risk of just letting a box sit perfectly still on a shelf?
Well, financially speaking, inventory is inherently fragile. Physical damage is a big factor, of course.
Like a forklift backing into a pallet.
Exactly. Accidents happen on the floor.
Yeah.
Then there's theft, or what the industry politely categorizes as shrinkage. It's a constant bleed, but the most insidious and expensive unseen risk is obsolescence.
Oh, wow.
Right.
The market doesn't freeze just because your inventory is sitting in storage.
Exactly. If a company is holding $3 million of consumer electronics, or like fast fashion apparel, that product is losing value every single hour.
Because a competitor launches a new model, or consumer trends shift overnight.
Yep. And suddenly, those perfectly pristine boxes in the warehouse aren't worth anywhere near the original purchase price.
They might be entirely worthless.
And that is a highly quantifiable 7% risk. So when you run the formula...
Let me do the math. 24% of that $3 million average inventory.
Right.
That means this company is bleeding an additional $720,000 every single year.
Strictly for the privilege of letting their own assets sit stationary.
$720,000.
Yeah.
That's an insane annual penalty just for holding goods.
It is. Which is why the immediate logical reaction for any operations manager seeing that number would be to radically slash inventory level.
Right, you just say, well, I'll order in tiny, frequent batches so the shelves are always empty and drive that carrying cost down to zero.
But doing so immediately triggers the other side of the seesaw, ordering costs.
Right. Because placing an order isn't free.
Not at all. The friction of placing an order is incredibly expensive. You have purchasing cycle costs.
Like paying the salaries of the buyers.
Yes, buyers negotiating and expediting those frequent orders. There are administrative costs attached to generating, routing, and approving every single purchase order.
And if you make the stuff yourself.
Then you face factory costs, production control, machine setup, and the devastating cost of lost capacity while a line is shut down to retool for a new batch.
Let's look at the math example from the text because it illustrates this friction perfectly. So imagine a warehouse department burdened with $200,000 in annual wages.
Okay.
And $80,000 in operating expenses. So that's $280,000 total.
Right.
If they place 4,000 orders a year, you divide that overhead by the orders.
Which is $280,000 divided by 4,000.
That comes out to $70. That's $70 in purely administrative drag just to process one single order.
Now add a standard $100 factory setup cost to that.
Oh, wow. So the average cost per order hits $170.
Exactly. Now multiply that $170 by the thousands of tiny frequent orders the manager wants to place to avoid the carrying costs.
That adds up so fast.
It does. Or look at the other example from the text with the import warehouse.
Right. The one where they spend $600,000 annually on customs, brokerage, wages, and expenses.
Yeah, and they manage 10,000 orders, so that's $60 per order.
And then you add in their $135,000 in carrying costs.
Which means their total annual expenditure just to manage the inventory flow is $735,000.
That creates a brutal paradox for supply chain leaders. I mean, think about it. If you consolidate into massive, infrequent bulk orders, you practically eliminate that $170 ordering penalty.
Right, but then your warehouse overflows and your carrying cost explodes into the millions.
But if you attempt to run a lean just-in-time operation, you eliminate the carrying cost, but paralyze the company with exorbitant ordering and setup fees.
Exactly. Finding the precise mathematical trade-off between those two opposing forces is the holy grail of inventory management.
It's a constant seesaw.
Yep. Lowering one side inevitably elevates the other, unless, the company is willing to fundamentally re-engineer its entire supply chain infrastructure to change those underlying variables.
Okay, so assuming a company actually finds that equilibrium, there's a secondary, maybe even more complex challenge.
How they report it.
Right. How does the organization actually report these massive hidden costs? It turns out the reality of how a business is operating versus how it tells the world it is operating
rely on two completely divergent languages.
Exactly. Financial accounting and managerial accounting.
And confusing those two languages leads to catastrophic strategic errors.
So let's break them down. Let's start with financial accounting. That's the external one, right?
Yes. Financial accounting is the public-facing language. It is engineered specifically for audiences outside the company's internal operations.
So we're talking about shareholders, institutional investors, creditors, tax authorities, regulators.
Right. And because those entities are risking external capital or, enforcing tax laws, the reporting mechanisms have to be utterly inflexible.
They are bound by standardized frameworks. Like in the U.S., it's GAAP, generally accepted accounting principles.
And internationally, it's IFRS. These frameworks dictate strict methodologies for how and when revenues and expenses are recognized,
leaving zero room for operational context. It's kind of like a company's highly sanitized public resume.
That's a great way to put it.
It has to be formatted exactly right and follow all the societal rules so outside regulators can grade it on a standardized curve.
That standardization is vital for macroeconomic trust, so banks can confidently compare the financial health of two competing firms.
But that intense rigidity must render financial accounting almost useless for an actual manager on the floor.
It does. If you're trying to survive the daily operational battles in a warehouse, GAAP compliance doesn't help you make a fast decision.
Which necessitates the second language, managerial accounting.
Right. This is the internal playbook. It is designed explicitly for the executives and managers making real-time decisions.
Meaning it does not need to be GAAP or IFRS compliant?
Exactly. It's entirely exempt. The defining characteristic of managerial accounting is utility over compliance.
So it's more timely, more varied.
Managers require immediate granular data. They might need daily variance reports on a specific production line rather than waiting for a quarterly GAAP compliance statement.
And crucially, they can omit certain data if doing so helps leaders make better decisions.
Right. It intentionally reclassifies or ignores some financial data if it provides a clearer picture of operational efficiency.
It's the equivalent of trying to navigate a live naval battle. Financial accounting is a map drawn for historians. It's accurate, standardized, but delivered months too late to dodge a torpedo.
I love that analogy.
Managerial accounting is a live radar feed. It might not look pretty for the referees, but it tells the captain exactly where to steer right now.
Let's examine what happens when the financial accountants do compile those standardized historical maps, though.
Right, the financial statements. The source material highlights 3 primary documents where inventory plays a massive and honestly sneaky role.
Starting with the balance sheet.
Okay, the balance sheet is basically a static snapshot. It captures what a company owns and what it owes at one specific millisecond in time.
And the entire document is governed by the foundational equation. Assets equals liabilities plus owner's equity.
Right. Let's use the text example. If you have assets of $5,000 and liabilities of $3,000, your owner's equity has to be $2,000.
It has to balance. Everything a company has must be funded either by borrowing money, which is a liability,
or by owner investment, the equity.
Right. So if they pay a $1,000 dividend to owners, the assets drop to $4,000 and the equity drops to $1,000. It always stays in balance.
So where does inventory fit into this?
Inventory represents a massive proportion of the total assets for any product-centric company. It sits heavily on the left side of that equation.
And the strategic implication here is that acquiring more assets like building larger stockpiles of inventory mandates an equal increase on the right side of the equation.
Exactly. A company cannot spontaneously generate inventory out of thin air. It must take on debt to finance it or dilute ownership to raise the capital.
So let's apply that to how executives can actually use the balance sheet to camouflage supply chain inefficiencies.
This is where it gets fascinating.
If a warehouse is bloated with unsold, potentially obsolete inventory, it still registers on the balance sheet as a massive asset, right?
Yes, it does. To an untrained investor, just glancing at the top-line numbers, the company looks incredibly asset-rich.
When in reality, they might be drowning in the debt required to keep those stagnant boxes on the shelf.
Which is precisely why the balance sheet must be cross-referenced with the second document, the income statement.
Also commonly known as the P&L, or profit and loss statement.
Right. Unlike the static snapshot of the balance sheet, the income statement is like a video recording of financial performance over a defined period, like a quarter or a year.
And the mechanics of the P&L operate like a waterfall. Top-line revenue flows in at the top.
And the very first deduction is COGS.
The cost of goods sold.
Which leaves your gross profit. From there, you subtract operating expenses, depreciation, and interest to reach net income before taxes.
And finally, taxes are paid, and the remainder at the very bottom is your net income.
Now, what's fascinating here is how the accounting treatment of inventory fundamentally distorts operational reality on this statement.
Wait, I remember a crucial detail from the source. So unsold inventory isn't an expense yet. It just sits on the balance sheet tying up cash.
You got it. Raw materials, work-in-process goods, and finished items sitting in a warehouse are absolutely not recognized as expenses on the income statement.
That is wild.
They are capitalized as assets on the balance sheet. They only transition into an expense, specifically hitting that COGS line at the exact moment they are sold to a customer.
The strategic delay there is crazy. I mean, a company could be burning through millions of dollars in actual cash to purchase raw materials and pay factory labor to build products.
Yep. Their bank accounts are draining.
Yet, because those products haven't sold, the expense hasn't been recognized?
Exactly. So their income statement might project record-breaking profitability, completely masking a severe operational cash bleed.
It's trapped cash masquerading as an asset.
And this is the exact vulnerability that the third document, the Statement of Cash Flows, is designed to expose.
Because it strips away the accrual accounting magic of the income statement.
Right. It tracks the literal movement of cash in and out of the company's bank accounts.
So when you analyze cash flows from operations, a ballooning inventory level appears as a direct, glaring deduction.
It acts as a drain. It confirms that accumulating excess stock literally suffocates a company's liquidity, regardless of how profitable the P&L claims they are.
To prevent that suffocation, internal leaders, using managerial accounting, have to dissect and categorize costs. They need to understand how the business actually behaves beneath the GAAP regulations.
Right, because you can't manage what you don't categorize.
The source material outlines several critical cost classifications. Let's start with a distinction between QOGS and general and administrative, or G&A, expenses.
This separation isolates the cost of manufacturing from the cost of corporate infrastructure.
So QOGS encompasses the manufacturing side, direct materials, the direct labor assembling the product,
And factory overhead, like the maintenance, utilities, and property taxes specifically tied to the manufacturing plant.
whereas G&A captures the non-manufacturing overhead.
Right. Corporate human resources, accounting, legal, marketing, advertising, sales commissions, and outbound shipping to the customer.
Okay, taking that a step further, managers must also differentiate between variable and fixed costs to model different production scenarios.
This is a crucial distinction. Variable costs scale linearly with production volume.
Let's bring in the bicycle example from the text. If one customized bicycle requires $500 in parts and labor, scaling production to 2 bicycles is $1,000.
And 10 bicycles increases that cost directly to $5,000.
But fixed costs do not vary with volume.
Not in the short term, no.
Right, like the factory fire insurance. Whether you make 1 bike or 10,000 bikes, the insurance bill in the mail is exactly the same.
Exactly. Now, the complexity really escalates when we look at how those costs are assigned to specific products, particularly the division between direct and indirect costs.
Well, direct costs seem easy. They're directly traceable to a specific job. The titanium frame of the bicycle and the wages of the welder who built it, those are direct costs
But indirect costs are a managerial minefield.
because they require allocation.
Yes. You cannot directly trace the factory supervisor salary or the cost of forklift maintenance to one specific bicycle.
Right.
Those indirect overhead expenses have to be allocated across the entire production volume using some kind of estimated standard.
Let's test the logic of how dangerous bad allocation can be. Suppose a company manufactures 2 products, a simple, high-volume standard widget and a complex, low-volume custom widget.
Okay, classic scenario.
If they allocate the warehouse supervisor's salary evenly based simply on the number of units produced, the high-volume standard widgets absorb the vast majority of that overhead cost.
Which completely distorts the profitability analysis.
How so?
Well, the complex custom widgets likely require significantly more of the supervisor's actual time and management bandwidth, yet they are bearing a tiny fraction of the cost.
So the standard widgets are basically subsidizing the custom ones.
Exactly. So executives might review the margins and decide to heavily promote the custom widgets because they appear highly profitable.
Completely unaware that scaling up the custom line will aggressively multiply their unallocated overhead and bleed the company dry.
It happens all the time. That structural flaw leads directly to the managerial debate between absorption costing and variable costing.
Okay, let's define those. Absorption costing assigns all variable costs, plus a calculated portion of fixed overhead, to every unit produced.
Right. And while GAAP requires this for external reporting, it is highly problematic for internal performance reviews.
Because it unfairly penalizes operational managers.
Yes. A floor manager is judged on their production costs, but absorption costing forces them to absorb a portion of the factory's property tax or executive insurance premiums.
Costs they have absolutely zero authority to control or negotiate.
Right. So variable costing resolves this by isolating only the variable costs that the manager can actually influence. It provides a much cleaner metric for internal performance.
But to truly solve the overhead allocation nightmare we discussed with the widgets, the text introduces something called activity-based costing, or ABC.
Yes, ABC fundamentally alters how indirect costs are viewed.
It abandons the blunt instrument of allocating overhead based on simple unit volume, right?
Exactly. Instead, it identifies the specific activities that drive costs, like the number of machine setups required or the volume of quality inspections performed.
And crucially, ABC only assigns overhead based on the capacity actually utilized by the product.
That's the key. It isolates the cost of idle, unused capacity, preventing it from artificially inflating the cost of the goods being produced.
So it provides an almost surgical view of what a product genuinely costs the system to manufacture.
It does. Speaking of true costs, there is another classification that frequently upends procurement strategies: Landed cost, or the total cost of ownership, TCO.
TCO, I love the analogy for this. It's often lazily compared to an iceberg. The purchase price quoted by a supplier is just the tip visible above the water.
Right, but it functions more like a sprawling, predatory long-term contract with dozens of hidden maintenance clauses below the surface.
The total cost of ownership demands a comprehensive accounting of every peripheral cost triggered by a supply chain decision.
Because procurement might select a supplier overseas because the raw unit price is 15% cheaper.
Right, they see the cheaper price tag and jump on it.
But TCO forces them to calculate the hidden costs of that choice. The international freight, customs duties.
The financing cost of holding massive transit inventory on cargo ships for weeks.
Yes. The increased lead times and the management bandwidth required to navigate geopolitical disruptions and complex global routing.
So when those hidden clauses are activated, the cheaper offshore unit often becomes the most expensive strategic error the company can make.
Exactly. Now, once a company has successfully classified and allocated all these costs, they need objective metrics.
Right, to determine if their operational strategy is actually succeeding. Because efficiency isn't merely about possessing the correct inventory.
No, it's about ensuring that capital isn't trapped in the warehouse any longer than absolutely necessary.
Which relies heavily on the ultimate supply chain metric, inventory turnover.
Yes. Inventory turnover measures the velocity of capital. It calculates how many times per year a company completely sells through and replenishes its inventory base.
Let's give them the formula. It's annual cost of goods sold, the COGS, divided by average inventory in dollars.
And just to clarify, average inventory is simply your beginning inventory plus ending inventory, divided by 2.
The snacks manufacturer example from the text provides an excellent baseline for this. So they report an annual COGS of $15 million.
Okay, $15 million.
Their beginning inventory was $2.5 million and ending inventory was $2 million.
So that gives an average inventory of $2.25 million.
Right. Dividing the $15 million COGS by the $2.25 million average inventory yields 6.67 turns.
Meaning they cycle their entire stock roughly 6 2/3 times annually.
While that establishes the baseline, the true strategic power of supply chain management is revealed when you manipulate that velocity.
Oh, this is where the massive financial impact happens.
Let's walk through the larger scenario from the source material. Consider a corporation with $48 million in annual COGS and an average inventory of $12 million.
So 48 divided by 12. They're currently operating at 4 inventory turns per year.
Okay, 4 turns. Now, what if the supply chain executives optimize their forecasting, consolidate their network, and compress supplier lead times?
Let's say they increase that velocity from 4 turns to 10 turns.
10 turns. Okay, to support that same $48 million in COGS at 10 turns, the required average inventory plummets.
It drops to $4.8 million.
Wow. They have effectively eliminated $7.2 million of physical inventory from their network.
Without losing a single dollar of sales.
That is $7.2 million in liquid capital immediately freed from cardboard boxes.
And returned to the balance sheet to fund acquisitions, R&D, or debt reduction.
But wait, there's more. They are no longer paying the carrying costs on that vanished inventory.
Exactly. Bring back that 20% carrying cost rate.
Right. If we apply a 20% carrying cost rate to that $7.2 million reduction, the supply chain team just generated an additional $1.44 million in pure annual cash savings.
It proves that supply chain velocity isn't just about moving boxes. It is a primary driver of corporate valuation and generating millions in cash flow.
Complementing that velocity is another key metric, days of supply.
Right. While turnover measures historical annual performance, days of supply measures your immediate operational runway.
It answers a critical question. How long can the business survive if the supply chain completely freezes today?
The calculation is inventory on hand divided by average daily usage.
So if a distribution center holds 2,000 units and historically ships 200 units per day, they have exactly 10 days of supply.
Which is crucial because this metric directly dictates reorder policies.
Right. If the supplier requires a 10-day lead time to manufacture and deliver new stock, the system must trigger a purchase order the very moment inventory drops to 10 days of supply.
Otherwise, you guarantee a stock out.
Understanding velocity and runway is vital. But the final section of our source material addresses perhaps the most controversial element of inventory management.
Inventory valuation.
Right. At the end of the fiscal year, A company must assign a definitive financial value to the unsold boxes remaining on the shelf.
And this single accounting choice can radically alter the perceived profitability of the entire corporation.
So the three primary valuation methods are FIFO, LIFO, and average cost.
First, we really need to decouple the physical movement of boxes from the financial movement of numbers.
Yes, that's important. So FIFO stands for first in, first out. LIFO is last in, first out.
And average cost simply blends the costs, which is necessary for bulk commodities like chemicals or grain, where tracing specific units is physically impossible.
Let's focus on the disconnect between the physical flow and the accounting flow, because this is where the strategic magic or manipulation occurs.
It really is magic.
Take a grocery store selling dairy products. They will absolutely use a physical FIFO flow.
Right. They force the oldest milk to the front of the shelf to sell before it spoils. First in, first out, physically.
But financially, in certain jurisdictions like the U.S., that same grocery store can legally choose to account for those sales using LIFO.
Right. Acting on paper as if the newest, most recently purchased milk was the milk that sold.
Wait, does a company actually have to physically move the boxes in a LIFO order to use LIFO accounting?
Not at all. These are accounting methods to describe inventory movement financially. The physical movement can be completely different.
So why do it? The only reason to force a disconnect between physical reality and accounting reality is to weaponize the effects of inflation.
Exactly.
Yeah.
In a standard inflationary environment, prices are always rising. The cost to acquire inventory continually goes up.
Right. A unit purchased in December costs more than the exact same unit purchased in January.
So if a company utilizes FIFO accounting during inflation, they are matching their oldest, lowest historical costs against their current revenue to calculate their cost of goods sold.
Because the COGS is artificially low, their reported gross profit is exceptionally high.
And Wall Street analysts and shareholders absolutely love high profit margins.
Furthermore, the unsold inventory remaining on the balance sheet is valued at the newest, highest purchase prices.
Making the company look incredibly asset-rich and profitable, it appears completely optimal.
Until the tax bill arrives.
Yep. That artificially inflated profit translates directly into a massive corporate income tax liability.
Which is exactly why many companies opt for LIFO accounting.
Right. Under LIFO, they are matching their newest, most expensive inventory costs against current revenue.
This drives their COGS up, which intentionally suppresses their reported profit.
Precisely to minimize their tax burden. LIFO shields cash flow by ensuring the company is taxed based on the actual current cost of replacing the inventory they just sold.
It is a highly effective tax mitigation strategy, but that strategy inflicts severe collateral damage on the balance sheet. Well, if a company uses LIFO for decades, the unsold inventory sitting on their books is technically valued at historical costs from 10 or 20 years ago.
Oh, right.
You have modern, valuable assets recorded at 1990s prices. That grossly understates the company's true asset value and severely distorts their debt-to-equity ratios.
It creates a fascinating scenario where two competing firms possessing identical physical warehouses selling the exact same volume of goods at the exact same prices
Will present completely divergent financial realities to the public solely based on their choice of FIFO versus LIFO. It's just a completely legal accounting choice that drastically alters reality.
It is. Now, the final valuation concept detailed in the text involves an entirely different internal market: transfer pricing.
This applies to multinational corporations moving inventory between their own internal subsidiaries, right?
Yes. Think about when a manufacturing division in, say, Germany produces components and ships them to an assembly division in Mexico.
A transaction must occur on the internal ledger.
Exactly. The overarching corporation must dictate the transfer price for those components.
Do they transfer them at raw manufacturing cost, at a negotiated internal markup, or at the open market price?
This internal pricing mechanism dictates the profitability of each subsidiary.
Right, because if corporate sets a high transfer price, the German manufacturing division looks incredibly lucrative.
Maximizing the bonuses for their executives.
But that high price becomes an exorbitant raw material cost for the Mexican assembly division.
Destroying their margins and making them appear highly inefficient. It literally turns internal divisions into hostile competitors.
But beyond internal politics, transfer pricing attracts massive scrutiny from international tax authorities.
Very much so. Corporations have historically manipulated transfer prices to artificially shift profits out of high-tax jurisdictions and into low-tax jurisdictions.
Like they overcharge subsidiaries in high-tax countries to wipe out their taxable profit.
Exactly, and capture that profit in a subsidiary located in a tax haven.
Wow. Consequently, global regulators enforce strict guidelines requiring transfer prices to reflect realistic, arm's-length market transactions.
You can't just make up numbers to avoid taxes.
Well, we have mapped an immense amount of territory today.
We really have.
We started by calculating the crushing burden of carrying costs and the hidden friction of ordering costs.
We explored how the rigid mandates of financial accounting force executives to maintain a parallel system of managerial accounting just to survive.
We dissected the dangers of poor overhead allocation, the strategic necessity of activity-based costing, and the massive cash flow generated by simply accelerating inventory turnover.
And we concluded by revealing how accounting methodologies like LIFO, FIFO, and transfer pricing allow corporations to legally sculpt their financial reality.
Emphasizing that understanding the numbers requires understanding the rules used to generate them.
Which leaves you with a final thought to ponder. Consider the business headlines you read tomorrow. When a massive corporation boasts about soaring, record-breaking profits during a period of heavy inflation, stop and ask yourself a structural question.
Are they genuinely outperforming the market through superior products and supply chain excellence?
Or are they simply capitalizing on the accounting mechanics of FIFO, letting inflation artificially suppress their reported costs?
While their underlying operational cash flow secretly bleeds out in a warehouse full of cardboard.
Exactly. It changes how you look at the news.
It really does. Thank you for taking this deep dive with us today. Keep questioning the frameworks behind the numbers, and we'll catch you on the next one.